and all the others. So what I have today is trying to tell you a little bit about investment analysis of gold. And how do we do investment analysis? Again, in every textbook they'll tell you there's just fundamental analysis and possibly, potentially, portfolio analysis. Well, turns out that we also have a cyclical analysis, yet textbooks never tell us anything about business cycles. We have behavioral analysis about people's psychology. When people are excited so much about the stock market and everyone's investing in the stock market, you expect or should expect a stock market crash. And when no one is investing in gold, that's when gold would be a very good investment. That's called contrarian type investing. You gauge people's psychology and then you do the exact opposite if you want to be a successful investor. For example, right now everyone's buying real estate. Well, sorry guys, real estate is extraordinarily overvalued. You're buying now or in the last 1 or 2 years real estate, you are doomed to suffer losses. Real estate is extraordinarily overvalued, maybe 2, 3, or 4 times. And there is also technical analysis if I have the time to get to that point. When it comes to cyclical analysis, we look at secular bull markets. And secular bull markets are long, very long term, 15, 20, 25, possibly 30 years and even more. And you can see the first one was 1906, actually 1907 till 1923. It's also associated with World War I. Then there's this next bull market from 33, that's the bottom of the Great Depression, all the way to 53, includes World War II. Then there's next cycle from 1968, some people say it's 1966, all the way till 1980 or 82, that's a little shorter, 15 years. And now we are yet in another bull market for commodities starting in 1999 or 2000, the dot-com telecom crash. The peak of the stock market is associated with the bottom of the commodity market. In other words, stocks go up, commodities go down, and the other way they move in opposite directions. Alright, so here is a simple cyclical analysis, and you see on the chart, it's a Dow-gold ratio. Dow tells you the value of stocks, gold tells you the value of commodities. When the ratio is very high, as it is over here in 1929, this means stocks are extremely overvalued. When you have the ratio very low, this means that stocks are undervalued and cheap. So you see, second time around, 1966, as I mentioned, stocks are extremely expensive and gold is dirt cheap. In 1980, it's the opposite. Gold is extremely expensive and stocks are dirt cheap. Similarly, you see in 1999, the peak of the stock market, the dot-com telecom bubble, gold is extremely expensive and stocks are stocks are very expensive and gold is cheap. Well, in 2011, the market got a little bit rebalanced, but now, 2017, the ratio between the stock market is, again, very high relative to gold. So what this chart tells us is that stocks are now significantly overvalued relative to gold, and gold is relatively undervalued. In other words, right now gold is cheap relative to stocks. Let's see what else I got. Oh, this is exactly the same chart from the second part on, and you can actually see and read at the top. Stocks high, gold is low. In other words, stocks are expensive, gold is cheap. Here, it's the opposite. Stocks are cheap, gold is low. Well, right now, we're closer to the stocks are a lot more expensive and gold a lot cheap. Next chart is on a cyclical analysis. It tells you whenever you have a commodity boom market, in other words, a commodity bull market, what performs well? And overall, usually oil and gold perform at their best. In other words, if you want to buy any kind of commodity, usually gold, usually oil, and usually silver perform best when you buy them, of course, at the right time. When it comes to fundamental analysis, you try to value, okay? So gold and commodities right now are relatively undervalued, There is strong demand by smart money. People, sophisticated investors, they are buying gold. But most of the people aren't really buying any gold. So investment by big money. Also, as people fear with quantitative easing and central banks printing money like crazy, quantitative easing, people fear inflation, and gold is by far the best inflation hedge known in the financial universe. Next one is currency hedge. As, for example, 2011-12, the European financial crisis, the ECB started printing money like crazy and devaluing the euro. If you would remember, the euro was $1.60, now it's $1.20, but it was down to $1.03. It is gold that provides the best investment in times of inflation and in times of currency weakness. It's also a crisis hedge. Whenever we have a financial crisis like 2008 and 2009, gold performs in crisis best. Nothing comes close to gold. In other words, gold functions as a hedge. It functions as a insurance. In bad times, gold does well. In good times, gold doesn't do very or relatively well. It's a great alternative asset. Yeah, there's nothing wrong with having some stocks and bonds and of course real estate, but gold adds extra diversification. That's part of portfolio. And at the same time, currently central banks, especially Asian central banks, are eagerly devouring as much gold as they can in order to build up their financial and central bank reserves in order to back up and strengthen their currencies. That's on fundamental analysis. There is separately, besides this, just pure investment demand. Dollar could be and is considered by some people weaker. There is significantly higher currency volatility for all currency markets, including yen and euro, and of course the Chinese yuan has become extremely volatile. So there is a general demand. Of course, there is financial market instability. Actually, right now is the opposite. Now, stock markets are so unvolatile that when they become volatile, that's when gold performs best. In other words, now markets are calm, don't perform well. Later, they will as the markets get jittery. Of course, there may be potential bankruptcies. The most notorious banks in Europe are Italian banks. Italian banking system is significant enough to bring down the whole European financial system. Now remember, just a small reminder, tiny little Greece, which is just a little nothing, banks in Greece, when they fell, it was threatening the Greek banking system was threatening the collapse of the European and global financial system. Now, Italy is 10 times bigger, okay? So when that thing eventually happens, and Italy has about $350 billion of bad loans. Of course, you have sovereign wealth funds like Abu Dhabi, like in Dubai, like in other Kuwait and other countries. They are buying gold. You got a lot of institutional investors and of course ETFs. So overall, there's a strong investment demand on top of all the other hedges that I spoke about. And there is some fundamental analysis. You can actually see overall demand throughout the years for demand for bars and coins. You can also see in 2009, 10, and 11, during the global financial crisis, gold demand skyrocketed. 2013, that's the European, the Greek financial crisis, or the Mediterranean financial crisis. Again, gold demand skyrocketing. In other words, the market now is calm for gold because stock markets, there's no real genuine crisis. But crisis eventually is coming. That's another topic probably for some other speakers. And of course, there is jewelry demand. All of these Chinese and in Thailand and in Hong Kong and in Singapore, they're all eager to buy gold for jewelry. And industrial demand, all the phones, iPhones and computers, they all need a little bit of, even of 1/100 of an ounce of gold, but that in terms of billions of phones still adds up to a significant overall demand. All right, currently gold investors own more gold and whatnot. Let me see what other analysis. Okay, that's this is the central banks balance sheet. What it simply tells you that since 2003 and later since 2008 during the global financial crisis, central banks are printing like crazy. We have never seen in financial history so much money printing. And we all know, as you print money, money loses value. Money depreciates. And when money depreciates, you go to a stronger currency, but now because there is no stronger currency, the only thing left is gold. Again, fundamental analysis, stocks are currently highly overvalued. You can, price earnings and all these stuff. Bonds are currently highly overvalued. You're barely earning 0.5% if you're lucky, 0.25%. In Italian bonds, 1%. Bonds yield nothing. Overvalued real estate. In other words, you got a stock market bubble, a bond market bubble, a real estate market bubble. A lot of currencies are overvalued. You got a whole bunch of currency wars. You should all know and understand Jim Rickards and his currency wars thesis. So in this type of environment, when all other assets are relatively overvalued or in a bubble, it's gold which is relatively undervalued. And of course, besides gold, commodities in general are undervalued, not just gold. I mean, rice, wheat, all the other commodities are also significantly undervalued. Now, when it comes to portfolio analysis, gold has one very beautiful property. It is highly uncorrelated to other asset classes. It's highly uncorrelated or negatively correlated to stocks, uncorrelated to bonds, somewhat to no correlation with real estate. So adding gold to a portfolio adds additional diversification to your portfolio. It adds resiliency. It adds return at no extra risk. That's the benefit of diversification. And different calculations show that anything between 10 and 25% of gold in your portfolio will add overall return and lower overall risk. So optimums anywhere between and around 15%. Again, negatively correlated to currencies, which adds diversification. Okay, it improves, I already mentioned, risk-return portfolio. Again, research shows for some 5%, for some 10%, depending on the environment, what is optimal in terms of diversification. Let's see what else I have. Behavioral analysis, that's number 4, is, well, gold is not really well understood. As I began, it's nothing, not a single paragraph in any of my textbooks doing bachelor's in economics and master's in economics and PhD in economics. I'm teaching 20 years, 18 years now, finance, and gold is not in textbook. Students don't know nothing about gold. Bankers don't study, don't know gold. Gold is not part of financial education, and therefore it is poorly understood, most often misunderstood. People don't love it, the people don't understand it. So people are not excited about gold. Usually, how many of you own at least 10% in gold? My good guess is that out of, let's say, 100 people, maybe 5, maybe 10 at most will own maybe 10% in gold. In other words, pretty much most people have little or no gold in their portfolio. Again, one of the bigger problems is that gold is very hard to value. Valuation in finance is based on cash flows. In cash flow analysis, like stocks have dividends and bonds have interest, but gold has no cash flow. Real estate has a cash flow, so it's easy to value. And that's why they say, well, if gold is hard to value, they don't know how to value. There is no modern financial valuation method to give you a proper financial value of gold. So how is gold valued then? Demand and supply. There's a certain amount of gold that's available, and then there are 2 billion Asian women eager to have gold and get gold on their hands, and then they got 2 billion Asian men eager to kill in order to get the gold for their women. That's where the demand is coming from. Are they willing to kill, right? Oh, well, they're gonna lie, they're gonna rob, they're gonna cheat, but they're gonna get the gold that their woman wants. And in India, you can't even get married without gold. And of course, you need dowry in Thailand. You can't get married without. So most cultures in Asia are related to gold. Gold is an integral part of the culture. And I don't even talk about the Arabic and Arab culture where gold is everything, where gold rules. Okay, so that's how gold is usually valued. And gold's been now for 40 years going down and down and down, and gold's now forgotten. Nobody's investing in gold, and that's when you want to invest in gold. Currently, gold is not exciting. Right now, stocks are exciting and everyone's buying them. Bitcoins are very exciting and everyone's buying them, right? Real estate is exciting and everyone's buying them. But when everyone's excited, that's when you don't want to invest. That's when the asset is already overvalued. You want to buy when no one is buying, when there is no excitement factor. And then there is technical analysis. Gold is in a secular, probably 30-year bull market. You had the first leg on the way up from 2001 until 2012-13. We have now a 4-year correction. We had it from 2012 to 16. Now gold is in the second leg up, and based on the cyclical analysis, which I spoke at the very beginning, we could expect gold to have another 8, 10 to 12 years of another leg up. And on that leg up, if it's now 12 or 1,200, it's probably going to go anywhere between up to 5,000, maybe up to 10,000 easily. Let's see what else I have. And of course, we got technical corrections. That's fairly straightforward. I have a longer term, well, it's a chart from 2,000 year. All right, let me explain a little bit about this chart. You have a bull market from 1966 until 1980. And now you have the current bull market. Back then, from 1966 to 1980, the bull market lasted just about 13, 14 years. And when you overlay the current bull market is the pink, you are having matching the current bull market, matching very nicely with the old bull market of 40 years ago. And right now, as you see, the old bull market had a huge crash, a correction of 50% from 1973 until 1975, and now we just went through a similar correction from 2012 until 2016. So gold is just about getting the second bigger leg on its way up. That's a straightforward technical analysis. Right now, you're looking, the big correction I was talking about was from, you see, 2011, where the peak is, down to about 2015. That's the 4-year correction, which is similar to the 1973-75 correction. And from 2000 and now you see 13, 14, you're having a nice wedge, and it can go on for a while longer, maybe 6 months, maybe even a year, but it can get out, and when it gets out, it's gonna move relatively explosively. Technical analysis just tells you that different months in gold perform differently. Some months are not as great, like February and November, and some months are a whole lot better, like January, May, and possibly August and December. Gold, how to invest? Well, you could do it in gold certificates. Not a great way, but it's still something, like buying a gold certificate in a Swiss bank. You can have a gold account, again, maybe in a Swiss bank or maybe in a Singaporean bank. You can have a gold storage somewhere, anywhere, you know. In Singapore, they do that. In Hong Kong, they do that. Most places will do that. You could do gold mining stocks. There is also called gold spread betting, but that's more of a speculative type, highly leveraged, not a good idea. Gold ETFs, there's a GDL and so forth. And of course, the better way to do gold investing in gold is by just buying the coin or the bar itself and keep it away and outside of the financial system. What's an overall conclusion? Well, all investment analysis, whether you look at it from cyclical or fundamental, portfolio, behavioral, technical analysis, they all suggest that gold now, in end of 2017, is an overall excellent investment. Now, it doesn't mean you put in 100% of your money in gold, but 10, 20, 30 is reasonable. If you do expect stock markets to crash or to have a financial crisis, you should put even as much as 50% if you expect a crisis and want to protect yourself. And this is what I've written out there. 5-10% if you just want to be a little bit diversified. 10-15% if you really want to be balanced according to scholarly research. Now, you want to be more aggressive, 20-40%. If you do, for some reason, expect crisis, then 50% is perfectly reasonable. In other words, half of your wealth should be just staying and sitting in gold, waiting out a potential crisis. Well, thank you very much for your time and attention.